I mean, I think that it's pretty simple. If you think about the direction and the cost of capital, unless the Fed starts aggressively easing and does another round of QE, it's hard to imagine that short rates are going to go lower from here. And then if you look at other sources of upward pressure on the cost of capital, you've got credit spreads relatively tight and potentially widening over the next 12 months. You've got a higher kind of penalty on owning debt from a corporate standpoint, given that tax reform now isn't as advantageous for corporate debt owners. And then you've got, all sorts of other upward pressures on the cost of capital, which I think conspire against companies that have high leverage ratios, that need to borrow to grow their businesses. So I think where we are right now is an environment where probably the most important decision that we make as investors when we look at our portfolios is, do I own companies that generate capital, or do I own companies that need capital to survive? And what you want to stick with are companies that are throwing off cash, and you want to avoid companies that are burning cash. So I think it's interesting within the context of earnings, where you've seen companies that have guided higher on CapEx have actually been penalized for that, because that's seen as a source of cash burn. If you look at companies that are spending more on either labor or building out excess capacity, or all sorts of costs coming back online, these are basically draws on capital. And I think that that's the name of the game, is you want to avoid companies that are spending or being forced to spend either on interest payments, higher labor costs, CapEx, et cetera, and look for companies that are simple cash generators. So it's not
Savita,
as easy as it sounds.
So before we get to your specific sector and stock picks based on that view, is it not fair, though, to say that the cost of capital on a historic basis is still pretty low, and more to the point, balance sheets are still pretty strong? So maybe this isn't as clear and stark a factor for stock picking as perhaps it was in 2006-07.
Well, here's the thing, though. I think that what's going to catch investors by surprise is this is a big change from the normal environment that we've been in for, multiple decades. I mean, think about it. We're now you're right, we're at super low levels on interest rates. I think that the 10-year is in like the 15th percentile of lowness. So it's not like rates are high already. But I think that if you think about what drives equities and what drives sector and style rotations, it's all about that marginal move. It's about the second derivative. And even though rates are low, they're likely to move higher. Even though credit spreads are tight and companies can borrow pretty easily, the direction, I think, is more important than the actual level at this point.